Hi, everybody, and welcome to this special episode of Prinsights Spotlight. Well, I am pleased to welcome to the spotlight Laurent Lequeu, who is coming to us from Singapore and author of the very popular Substack, The Macro Butler. And Laurent, I want to get all into the Substack that you have. And by the way, I love the icon that you have for it. It's like the best one out there on Substack to me. But also, if you could tell our members and audience a bit about your background, because you headed research departments. I mean, you come to what you're doing with so much experience in your career and on the ground. So maybe tell us a bit about sort of that, and we can go from there.
Hi, Nomi. It's my pleasure to be on your show. I've been working in financial markets for almost 27 years. So I'm originally from Belgium, and I work in asset management and private bank before in Europe, and most recently in Singapore. And since November 2023, I founded the Macro Butler, and I'm also an independent advisor for high net worth individual.
Well, thank you for that. And it's so interesting. Again, you have run asset management areas and research departments, and you are independent, which I think is very important because we need independent insight and analysis into what's going on in the markets today. So you write about so many aspects of the markets, from what the EU is doing to what's going on in Asia to what the US is doing. If you had to pinpoint two or three of the most important things that are going on right now from an economic perspective that impact asset allocation, what would you say?
I look at the world through the lens of the business cycles and different cycles. So I think that what is more important for investor and even for your listener is not to fall into the false narrative of the mass media. In fact, I enjoy to be an independent writer and an independent advisor is because, in fact, I can base my analysis on facts and ratio rather than on narrative that has been created most of the time by Wall Street, but also by mass media to influence investor and even citizen. So if I would like to look at the world right now, I mean, as I said, I look at financial markets and the world through the lens of the business cycle. In fact, I look at three key ratios that are driving my asset allocation. One is the S&P to oil ratio. The second one is the gold to bond ratio. And the third one is the S&P to gold ratio. So what these ratios are telling investor without being, I would say, impacted by the narrative that is spread by mass media and Wall Street bankers is that the S&P to oil ratio, in fact, give you a state of the health of the US economy. If this ratio is rising and is above the 7-year moving average, it means that corporate America is still able to generate profit based on the input cost, which is driven by energy prices. So as of now, this ratio is still moving upward and is still well above the 7-year moving average. So we can still say that the US economy is in a boom phase. The second ratio that is being important to monitor is how investor can store value, and there are basically two ways to store value: is through investing in physical gold or through investing in government bonds. So if you look at the gold to bond ratio, in fact, it has been rising quite sharply since the start of the decade. It has been above the 7-year moving average, indicating that whatever the central bankers, the politician, and the media are telling investor, the US economy is in an inflationary environment because gold has been the way for them to preserve their wealth and not bonds. So in a few words, and if I want to summarize, I would say that for the time being, the US economy is in an inflationary boom. But I look at the third ratio, which is the S&P to gold ratio. And this ratio, in fact, I name it the indicator of monetary illusion, because you can have a rising stock market in US dollar terms. But at the end of the day, if the rising stock market is only in US dollar terms or in paper money and not in real terms, i.e. in gold terms, you are kind of fooled into a monetary illusion. And that's what's happening, in fact, in the US for the time being. So, of course, gold has widely outperformed the S&P 500 over the past 3 years. And on top of this, in fact, on January 20th, it could be a sign of destiny. This S&P to gold ratio broke below the 7-year moving average. So what this ratio is telling us is that on the January 20th of this year, investor was given a canary in the coal mine, that the risk for the US economy is to move from the current inflationary boom into an inflationary bust. So an inflationary bust is basically a nice way to call a stagflation.
Right. And do you see that changing, or do you see this sort of continued inflation, continued boom, but perhaps slowing down or staying at the same pace, but this monetary illusion ensuring that real assets still remain the better way to invest in any growth or the growth of the US or in general?
Well, I would say first that nobody can change the trend in cycles. What can be changed is the pace of this cycle materialize. So the fact that Donald Trump was elected president rather than Kamala Harris probably just delayed the US economy to move from a boom into a bust. But ultimately, the US economy will move into an economic bust sooner rather than later. So I would think that in the environment that we have, and it will also depends how fast and how much of the tariff policies are implemented, will also depends or the war cycle and the geopolitical situation in Eastern Europe, in the Middle East, and potentially also in Asia evolve over the next few weeks and months. But clearly, with the latest weekend event in the war between Russia and Ukraine, we could think that we are on the verge of an escalation in the war cycle in Eastern Europe. In the Middle East, I only see also an escalation coming probably between Israel and Iran over the next few weeks or months. So all this evolution in the geopolitical situation could accelerate, in fact, the US economy to move into an economic bust, because, I mean, for the economy to move into a bust, you need a much higher oil price. And since demand is relatively weak, because let's be fair, the rest of the world outside the US is already in a weak growth environment. I would say for triggering an economic downturn in the US, you need a much higher oil price, and this much higher oil price can only come from a supply shock rather than a demand shock. So I mean, if we look back at history, and to come back to your question, sorry, I take a long way to explain the answer to this question. But if you look back at history, when an economy is moving into a stagflation, in fact, what investor must own is real asset and physical asset. And of course, this means that I would think that they must own primarily gold, but also silver, other commodities as well, and of course oil. As I think that the upcoming economic bust in the US will be most likely driven by much higher oil price.
Yeah, it's so interesting. And one of the things I do love about your work and the work you're doing at the Macro Butler and your very successful Substack, and I encourage people watching or listening today to check out the Macro Butler. I am a subscriber and an avid reader of your research, Laurent. And it is very interesting that you do talk about oil and gold in that manner because it just so happens that I agree with you, which is not why I'm talking to you today. But I do agree that it would be a shock that would happen to encourage oil prices to go higher, and that would have, of course, a negative impact on corporate America or on any corporation that needs to fund its energy. And right now, that's not an issue, but it can be, and that could cause a dent, as you're saying. And then also gold. You mentioned that we're potentially at the doorstep of a 7-year pivotal moment in gold. And of course, we've seen gold outperform, as you said, the SP 500 and more, not just investors, but nations, sovereign wealth funds, pension funds, insurers coming into gold as a viable extended part of their portfolios. And I wonder if you could talk about that a bit. I know you have a model portfolio as well at the Macro Butler, and just sort of address that aspect.
Well, I would say that to keep it simple, gold is for war because gold is an anti-fragile asset with no counterparty risk. And where it's war and the world is devastated by geopolitical conflicts. In fact, as an investor, you don't want to have too much risk in terms of counterparty. And why gold has done so well so far, I would think that the key turning point for gold has been in February 2022, when the West, meaning American and European government, started freezing Russian assets. I mean, it clearly gave the signal to other emerging market investors that owning government bonds in the West, or owning currencies in the West, or even owning shares of American or European companies was not a safe way for this investor from emerging market to protect their wealth. So what has happened since, I think that we have seen a lot of central banks in Asia, in the Middle East, and in Africa starting to divest their US treasuries and replace these US treasuries by gold. In fact, we are still at an early stage of this process. And I wrote a piece recently on gold, and I highlighted that the gold bull market that we have seen remains really aided, especially by Western investors. There's almost no participation to this bull market by American and European institutional investors. Retail investors in the US are still well underweight in terms of physical gold. While on the other side of the world, we have seen retail investor in China piling into physical gold as a way to preserve their wealth, since the property market has been crashing in China over the past 2 years. And we have also seen institutional investor outside the central bank. I mean, we can see in China some insurance companies using physical gold as a way to deliver a return for their investors. So I think that the Western world has not really yet realized what's happening with the government debt in Europe and in the US. And once these investors wake up and realize that it's not a good idea to own government bonds or any kind of bonds in a current environment of a potential stagflation, and especially in a situation where, I mean, government could use geopolitical conflict also to default one way on the other on their obligation to their bondholder. I mean, this will be the the way that gold go exponential. And I expect this will happen gradually first and then very fast. And we could easily see the gold price peaking in US dollar around 2028 or 2030.
And what do you see? I mean, if you could put it, if you would put a number to that, given the trend, given that we have, 36 going on $37 trillion of U.S. debt, given that this budget that's being discussed right now in Congress could pass with some alterations, but still that's going to add debt. Where do you see sort of gold reacting to that in steps?
Well, as I said, on a 5-year time horizon, I won't be surprised to see gold price doubling once again from current level. So it would put the gold price by the start of the next decade, I would say around 6,800 or 7,000 US dollar per ounce. I mean, it's very difficult to put a value on gold on such. I mean, because it's also very difficult to understand. I mean, to expect how fast investor in the West will realize what investor in the East have already taken into account. It will depend on the evolution of the geopolitical situation and what is the reaction of Western government, especially from Europe and later probably in the US. How to address this debt recurring problem.
Yeah, no, I absolutely agree with you. This is a fascinating conversation, Laurent. Again, thank you for joining. I have some more questions for you on actually oil and gold and also the BRICS Plus. You mentioned that some of the turning points or that turning point most recently for gold would have been in Feb 2022 with the sanctions and everything else. And of course, we've also seen so much development with respect to BRICS going from BRICS to BRICS Plus. There is a BRICS Plus meeting happening in a month from now. Gold is definitely a conversation, if not going to a gold standard, certainly using gold more and more in terms of reserves and as we have to political diversification as well as currency diversification. Where you see that growing? Because of course now BRICS Plus includes a lot of oil producers as well as the original set.
Well, I guess that if you look at the BRICS Plus, they are a lot of them are major gold producer. I mean, we have China, we have Indonesia among the largest gold producer in the world. And as you said, they are also major oil producer. So I don't think that BRICS Plus is targeting a common currency. In fact, I think that the target of BRICS Plus is to establish a new payment system, which is clearly an alternative to the SWIFT system. And remember that Russia was also kicked out of the SWIFT system, that China has been from time to time also threatened to be kicked out of the SWIFT system. So I guess that Russia and China are kind of very keen to develop a very serious alternative to the SWIFT system. And this is already happening, I mean, in fact, for most of the BRICS Plus countries. I mean, I take the example of India buying Russian oil in Indian rupee. So this has allowed the BRICS Plus to de-dollarize. I was saying that the issue that a lot of BRICS Plus countries still face is that they still have quite significant stockpile in US dollar denominated debt. And to be honest, I think that contrary to the West, which is most likely to try to find a way to default on this obligation, the BRICS Plus countries are not really keen to default, and they are looking, in fact, to reimburse slowly and steadily this US dollar debt. So I mean, the BRICS Plus countries are in a difficult situation because they still need US dollar to reimburse their US dollar denominated debt. But on the other hand, they want to increasingly deal between each other in local currency. I would think that a solution to this problem could come, in fact, via China and indirectly using Hong Kong. The HKMA, meaning the Central Authority of Hong Kong, holds almost $500 billion in US dollar reserve. That could be put, I would say, at work to help other BRICS plus countries to reimburse their US dollar debt. And this is part of, I would say, what I call the shift of the financial center of the world from New York into Hong Kong by the start of the next decade.
Okay.
And this will come at the same time as the economic center of the world move eastward. And I always think that the BRICS Plus will be articulated around the axis of Russia, China, and India. So Russia, of course, can provide a cheap access to commodities, which is needed for a prosperous economy. China, whatever American and especially American politics want to say, China has today is today the best manufacturer in the world, and then India has a growing demography. So India will be the next consumer market in the world. Will probably replace the US by the next decade, giving its demography. So, I mean, the BRICS Plus is clearly articulated around this axis of Russia, China, and India. And all the countries in ASEAN have quite understand this, and they come along through the BRICS Plus program. You had Indonesia, Malaysia, Thailand joining the BRICS as a member or as a partner. And I guess the partner will become full member by the end of this year or early next year. So I think that to summarize what's happening in the BRICS Plus, they still need US dollar to reimburse their debt. This US dollar, in fact, could be easily found in China via Hong Kong. And on the other side, they will increasingly de-dollarize their economy by trading between each other in their local currency. At the end of the day, I would think also that China, since China is and Hong Kong particularly, could become the new financial center of the world. In fact, China could guarantee kind of a way for other BRICS Plus countries to exchange their currency against a certain amount of gold. And that's why also we are seeing the PBOC building a massive reserve in terms of physical gold.
Yeah, I completely agree. I'm actually due to go out to Hong Kong next year, so I will be very excited to see those developments in process. And again, Laurent, I so thank you for your time and all the work I get to read and you producing for so many people at the Macro Butler. If you could just in closing here, because this has been a fascinating conversation. It's gone by so fast and touched on so many important things for investors and just general watchers of the world. Just kind of give a couple takeaways to investors who are already perhaps in gold, silver, and other commodities, and those who aren't. What their steps could look like, and then also where we can find you. And again, we'll put up links as well.
Well, I would advise everyone to own between 30 and 40% of their portfolio in physical gold. It's not going to be a one-line bull market. There will be some pullback. But if there is an asset to buy the dip, it is, according to me, physical gold. So I guess that in the next few weeks and months, the dips will be smaller and smaller, as I said, as many more people realize, especially in the West, that they need to own gold and they need to own a significant amount of their portfolio in physical gold. I would also advise investor to store this gold as much as possible in a private vault or outside the financial system. Unfortunately, I'm not sure, especially in the West, that these governments, when they are in bigger trouble, will go after the gold of a private investor. So, according to me, gold must not be stored in a bank vault or any kind of a public financial institution. That's my advice to all investors. And on top of gold, investor can own also silver, and if they have, I would say, the risk appetite, they can look at platinum and palladium, which are, I mean, extremely cheap compared to gold and even compared to silver. But I would think that, I mean, this is more for the investor who are kind of going down the rabbit hole. But for everyone, as I said, owning between 30 to 40% in physical gold is a must. And all they should finance this, it's clearly to sell bonds. Bonds is not an asset class to own in this kind of environment where the trust in public institution is declining, when inflation is structurally moving higher. So my advice for all investors, if they want to own bonds, is to look at investment grade bonds with not more than 12 months of maturity. And everything must be owned in US dollar because in the scenario that I just described, in fact, there are less and less US dollar generated by world trade. And as I said, a lot of investors and countries still need US dollar to reimburse their debt. So you will see probably the US dollar making new highs against all other fiat currency, while it make new lows against gold. So it's a bit a paradox, I understand, but I think that this is a key matter that investor must keep in mind. If they are interested to read the Macro Butler, they can just Google the Macro Butler, or they can look on Substack at the Macro Butler. If they want to be in touch with me, in fact, they can send me an email at info@themacrobutler.com. I enjoy answering all this email, and I'm happy always to be in contact with everyone from all around the world. And I'm also happy to discuss opinions with people who think differently from myself.
Well, I thank you so much for your font of information, for making the time today, coming to us for your first visit now, and hopefully the start of many more to come. Thank you so much, Laurent Lequeu. Thank you for everyone for listening here today. We will have the links up for the Macro Butler as well. And thank you so much.
It was my pleasure, Domi. Thank you.